When traders first enter the world of technical analysis, one of the most confusing things they face is market reversals. Prices move up, prices move down, and often they do so without warning. This is exactly where candlestick patterns become powerful. And among those patterns, the bullish Harami holds a special place. It is not loud, it is not aggressive, and it does not scream for attention. Instead, it quietly signals that selling pressure may be slowing down and that buyers could soon regain control. The bullish Harami pattern appears after a clear downtrend. The market has been falling, fear is present, and sellers seem to be in charge. Traders watching the chart may feel uncomfortable, especially those holding long positions. Then suddenly, the market prints a large bearish candle, followed by a smaller bullish candle that stays completely within the body of the previous candle. This simple formation carries an important psychological message: momentum is shifting. To understand why this pattern works, it is important to understand the emotions behind each candle. The first candle represents strong selling pressure. Bears are confident and buyers are mostly silent. The second candle tells a different story. The market opens within the previous candle's range and closes higher, but without breaking the previous candle's high. This shows hesitation. Sellers are no longer pushing price aggressively lower, and buyers are starting to step in carefully. This hesitation is what makes the bullish Harami so valuable. Markets rarely reverse instantly. Instead, they slow down, pause, and then change direction. The bullish Harami represents that pause. It shows that the downtrend may be losing strength, even if the reversal has not fully started yet. One mistake many beginners make is expecting every bullish Harami to cause an immediate rally. That is not how professional traders use this pattern. The bullish Harami is not a confirmation on its own. It is a warning sign. It tells you to stop chasing shorts blindly and to start watching for signs of buying interest. The context of the pattern is critical. A bullish Harami that appears in the middle of a sideways market has far less meaning than one that appears after a strong extended downtrend. The stronger the selling pressure before the pattern forms, the more meaningful the signal becomes. This is why experienced traders always look at the bigger picture before making decisions. Volume can add another layer of confirmation. When the first bearish candle forms on high volume and the second smaller bullish candle forms on lower volume, it often indicates that sellers are exhausted. If volume then increases on the next bullish candle, the probability of a reversal improves significantly. While volume is not mandatory, it can strengthen the story the pattern is telling. Support levels also play a major role. When a bullish Harami forms near a well-defined support zone, the odds of a successful reversal increase. Support zones are areas where buyers have previously shown interest. When price returns to those levels and forms a bullish Harami, it suggests that buyers are defending that area again. In real market conditions, the bullish Harami often appears during periods of uncertainty. News may be negative, sentiment may be bearish, and social media may be filled with fear. Ironically, this environment is exactly where reversals often begin. The pattern does not guarantee a reversal, but it provides an early clue that the worst selling pressure may already be behind us. Professional traders rarely enter a trade immediately after spotting a bullish Harami. Instead, they wait for confirmation. Confirmation can come in many forms, such as a strong bullish candle closing above the high of the second candle, a break above a short-term resistance level, or a bullish indicator signal aligning with the pattern. Risk management is essential when trading this setup. Because the bullish Harami is an early signal, false signals can occur. Smart traders define their risk clearly. A common approach is to place a stop loss below the low of the pattern or below the nearest support level. This keeps losses controlled if the market continues lower. The reward-to-risk ratio should always justify the trade. Even if the pattern has a high probability, taking trades with poor risk to reward can still lead to losses over time. Successful traders focus not on being right all the time, but on managing losses and letting winners run. The bullish Harami is widely used in markets such as stocks, Forex, cryptocurrencies, and commodities. It works across different time frames, from intraday charts to daily and weekly charts. However, higher time frames generally produce more reliable signals. A bullish Harami on a daily chart often carries more weight than one on a 5-minute chart. In fast-moving markets like crypto, the pattern can form quickly and fail just as fast. This is why combining it with trend analysis, support and resistance, and momentum indicators can improve accuracy. Indicators like RSI, MACD, or moving averages can help confirm whether bearish momentum is actually weakening. One interesting aspect of the bullish Harami is that it reflects indecision rather than strength. Many traders mistakenly believe that bullish patterns must show strong buying. In reality, some of the best reversal signals come from weakness in the opposing side. When sellers lose confidence, buyers do not need to be aggressive at first. The shift happens gradually. Market psychology is the real foundation of this pattern. The first candle scares late buyers and attracts aggressive sellers. The second candle creates doubt. Sellers who entered late may start to question their positions. Short-term traders may take profits.